Hi, I'm Marcel with Guaranteed Rate, and I want to give you another update on what's happening in this crazy mortgage market. And so right now we have a lot of changes happening specifically in the jumbo arena. So I want to talk about that real quick. Before I do that, you really have to understand kind of what happened back in 2007, 2008, and 2009 in terms of mark-to-market accounting and how that actually has an effect or impact on what some of the jumbo investors are doing nowadays. So first, let's talk about Lehman Brothers and Bear Stearns. These companies are no longer around, and in fact, they did go out of business during the financial collapse because of mark-to-market accounting. So I wanted to explain how that happened. So in essence, you had all of these different investors that were out there that were doing all sorts of different loans that were not really adhering to the Fannie Mae and Freddie Mac guidelines. At first, these loans were not risky at all. In fact, typically they would be, let's say, a 780 credit score with 30% down, and someone had to have, let's say, 12 months in reserves in order to qualify for these mortgage programs. Why did people do these? Because sometimes people had enormous amounts of tax returns and they didn't want to go through the work of doing a full documentation loan. So if they had exemplary credit, meaning, 780 credit score or so, they were putting a huge amount of money down, let's say 30% or so, and they had a significant amount of reserves, meaning how many months worth of payments did they have the capability of making liquid at the time of closing for their mortgage payment. These companies actually were very, very non-risk based companies. But over time, the risk really started to increase. What you started really seeing is that some of these investors now started decreasing some of these guidelines. You had other investment groups that would come out and do a 20% down program with a 740 credit score and only requiring 6 months of reserves. Then you had other companies that were coming out that were requiring a let's say 700 credit score, 10% down with only 3 months worth of reserves. And this really did kind of snowball until literally we were in an environment to where we were doing what were called ninja loans. They were no income, no asset, no job loans. These were absolutely ludicrous. So what ended up happening when the financial collapse started actually to occur is that all of these mortgages were not being securitized by Fannie Mae, Freddie Mac, and Ginnie, and with that they actually were adhering to their own guidelines, the guidelines that these investors came up with. Well, then when all of a sudden the market took a very sharp nosedive, all of a sudden you had all of these loans that were out there that didn't conform to the Fannie Mae, Freddie Mac, and Ginnie guidelines, and no one knew what was going to happen with these. They were certainly starting to go into default, and with that you had two companies, Lehman Brothers and Bear Stearns, that had a great business opportunity. They actually had the ability to purchase these loans, some of which on as 10 to 15 cents on the dollar. So let's say, for example, they had a mortgage of $100,000 on a home. With that, if they were able to get that mortgage for $10,000 or $15,000, even if that home depreciated in value 50%, they were still getting an incredible deal on that property. And so they were buying billions upon billions of dollars in these mortgage-backed securities, literally at 10 to 15 cents on the dollar. However, there is a rule out there called mark-to-market accounting. Now, this rule generally doesn't come into play very often because normally there's a market for everything. Even on mortgages, typically there's a dent, scratch, and ding servicer or mortgage company that will buy loans that don't necessarily fit in the box. However, once you have a freezing of the markets, meaning that no one is willing to purchase loans anymore, that's when market-to-market accounting really starts to have an impact, because it says that theoretically these loans can have zero value if no one on the market will buy them. So what does that mean? If you're Bear Stearns and Lehman Brothers, and let's say you've bought billions upon billions of dollars in loans, you're also lending out money, and you're using some of these loans that you have as assets to protect you in accordance with the FDIC regulations. The FDIC regulations state that of the assets that you have on your books, you can actually loan out, in many cases, 15% of those. So for every dollar that you have on your books, you can actually loan out 15 cents. Well, if mark-to-market accounting comes into play and you've just bought all of these different mortgages. And yes, you got an incredible deal on these mortgages, but the market freezes. That means that now you have to mark down this entire $1 billion of purchases, billions of dollars in purchases. You have to mark it down to $0. And so if the FDIC is going to be your regulating body, then they're going to end up saying, hang on, you have assets, we have to mark them down to $0, and you also have other people that you've loaned money to, you are now out of compliance. Now this all happened in 2007, 2008, really at the height of the economic turnfall, or basically downfall, that was happening there. And so the FDIC came in and they shut down Bear Stearns and Lehman Brothers. So now when we fast forward to 2020, we have to ask, well, what does all of this have to do with the market today? Well, that mark-to-market standard is still out there. And so what mortgage companies do, and mortgage servicers and banks, is they try to make sure that their loans adhere to the Fannie Mae, Freddie Mac, and Ginnie guidelines. Why? Because they protect against mark-to-market accounting. How do they do this? Because at any time, if you have a loan and it adheres at the time of origination to Fannie, Freddie, or Ginnie guidelines, you can take that loan and sell it as a commodity to other banking institutions, or you can actually sell it to Fannie, Freddie, and Ginnie. So with that, you really don't have any risk of mark-to-market accounting ever coming into play, because Fannie, Freddie, and Ginnie are still in a position to where they will actually purchase that loan from you. So that means that it can sit on your books as an asset. So with that right now, we see a lot of lenders that are wanting to do less loans because they don't meet Fannie, Freddie, or Ginnie guidelines. This means that jumbo loans specifically right now are under a tremendous amount of scrutiny because they don't conform to Fannie, Freddie, and Ginnie guidelines. In essence, they are going to be the banks or investor specific guidelines. So right now we have a lot of investors and lenders that have actually pulled out from jumbo loans, some of them completely. Some of them have put in some pretty significant overlays. I've seen some to where literally they're willing to do the loan as long as the client has, let's say, $250,000 invested with that specific bank. And again, why are they doing that? Because they don't want to be in a position to where they have any trouble with the FDIC when it comes to the amount of assets that they have in comparison to the amount of liabilities or loans that they've created. So right now, my hope is that this is very short-lived, but if you or your clients are thinking about a jumbo loan, it's certainly something you need to be aware of. If you have specific questions, please give me a call. Best number is 972-672-3246. Marcel with Guaranteed Rate, and hope you stay safe and take care. Thanks.